Welcome back to the Microlearning Institute. In this tutorial we look at a past exam question in the area of IAS 19 pensions. The specific question is from the CIMA past exam paper for F2 from May 2013 and it's question number 1, which was called GH. Firstly, in order to prepare our answer for this, we have to separate what's happening in the pension fund from what's happening in the income statement of the company GH. Of course, the fund has both assets and liabilities, and the income statement will recognize a corresponding net expense. We're told in the question that brought forward from April 2012, the fund contained assets with a value of $2.7 million and liabilities with a value of $3 million. Additionally, in the question, we're told that there is a past service cost of $200,000. This past service cost relates to the prior activities of the employees prior to this period and therefore is deemed to add to opening liabilities. So we add the past service cost to our liabilities, and also IAS 19 states that past service costs are recognized immediately in the income statement as an income statement expense. Additionally, we are told about current service costs, and again, quite literally, these costs are the costs that relate to the current service of the employees in relation to their pension. These current service costs add to the liabilities of the fund, and again, under IAS 19, are treated as an expense to the income statement. Now we need to look at what interest accrues, and this interest is as a result of moving forward in time, because of course the liabilities that are recognized in the fund are the present value of the future liabilities, and as the year goes by we move closer to having to fulfill those liabilities and make payments to employees who are treated by the fund. So the interest rate quoted in the question is 5%, and that 5% relates to the net opening liabilities. Now the opening liabilities, of course, that were brought forward were 3 million, but we also, if you remember, recognized an additional 200,000. So the interest that's deemed to accrue in the fund is 5% of 3.2 million, which is $160,000. And this interest adds to the present value of the liabilities of the fund, and again under IAS 19 is also treated as an expense of the fund. Additionally, we have the expected return on plan assets. And again, the opening assets of the fund are $2.7 million. Expected interest rates to reflect a return are 5%, and 5% of $2.7 million represents an increase in the assets of the fund of $135,000. This expected return on plan assets is treated as a net income in the income statement, thus reducing the overall expense recognized in relation to the fund. Next, we're told that the company puts $950,000 of cash into the assets of the fund, and again this cash injection into the fund, as advised by the actuary to the company, does not have any effect on the income statement. We're also told that the company pays $320,000 in benefits to retired employees. This $320,000, of course, is removed from the assets of the fund to purchase annuities for these employees. But of course, once these employees receive the annuities, they are also, these employees, removed as liabilities of the fund. So the effect of the payment of benefits is to reduce both the assets and liabilities of the fund. Payment of these benefits has no effect on the income statement. Finally, we're told that when reviewed, the fair value of the assets at year-end March 2013 and the present value of the liabilities were respectively $3.6 million and $3.8 million. Consequently, we need to reflect a balancing figure, which is a gain on the assets of the fund of $135,000, and also another balancing figure which emerges to be a loss on the liabilities of the fund of $110,000. The net of this gain on assets and loss on liabilities is recognized as an income to the fund of $25,000, i.e. a negative expense. So this slide shows us how we treat movements in the fund and how we take those movements in the fund to the income statement. Now we've got to look at what income statement extract we have for the activities of the fund and also what's left on the balance sheet. On the income statement, we take the net past service cost, current service cost, and interest expense and interest income, and we total those as a net P&L expense, and in our case this net P&L expense equates to $875,000. The movement or the net gain or the net gain in reclassification is taken to other comprehensive income and emerges to be $25,000 of a net income. So this is taken not to the profit and loss but to other comprehensive income. On the balance sheet, we simply show the net pension obligation, and of course the net pension obligation is the difference between the closing liability and the closing asset, which of course is a net pension obligation of $200,000 on our statement of financial position. Thank you very much for watching this short tutorial on IAS 19 pensions dealing with the CIMA F2 May 2013 question number 1 GH.